Hello, everyone. Welcome to today's webinar. We are still waiting for some people to hop in here from the audience, but before people are hopping in, Jack, David, Drew, do you guys want to kind of just give a little background of yourselves from there, and then we can go into the webinar itself.
Sure. This is Jack Boyajian. I'm the CEO of Still Property Group, and I'll be doing most of the presentation today. Looking forward to discussing um, our group fund launch.
Thank you. And yeah, so Jack, if you want to go ahead and just share your screen, and then we could start the webinar. We're going to go through
Sure.
the whole presentation, everyone, and we'll have some room at the end for some Q&A. So if anyone has a question, please leave it in the chat box. We'll make sure we have some time at the end for your questions. So go ahead, Jack. It's all yours.
Thank you so much. Okay. Hope everybody can see my screen. We thank you for all of you who are joining us. We're going to take a few moments to go through a few slides to discuss our group fund number one, which has already been launched, and we're going to have really and this is a residential adaptive reuse investment fund, and I know that some of you uh, may not know exactly what that means. So I'm going to go through essentially a series of slides as to answer really three fundamental questions. Why the Still Group is the ideal group to launch this and actively work in this space, and have you consider joining us as investors. Why look at the adaptive reuse specifically as an area of interest, and also why this particular fund, because there are reasons why this fund is attractive above others. And so we're going to take the first set of questions initially. So the Still Property Group is essentially a combination of different entities that have worked for the last 30 years in the field of conversions. We are considered actually a number one in the field of converting cooperatives to condominiums, but we've also done other conversions as well. So it puts us in a particularly interesting and opportune place to take advantage of what has been happening in the market recently, and that is the emergence of the adaptive reuse of existing properties, particularly office and hotels, to residential living. And we're going to talk a little bit about how that fits into our experience, and also why this particular time is ideal for that. So we have done up to 5,000 as a team. We've done up to over 5,000 units converting. Equity value that we've created in that process is over $500 million. As I said, we're considered number one in that co-op to condo conversion space, and we've done over 55 projects now. So we are ideally positioned to be a leader in this space. So the recent conversions we've done is approximately $100 million of assets that we've managed. Deal level returns have been 45% internal rate of return. And we are currently under contract with about $170 million worth of projects that we believe will return about a 2.6 equity multiple, which means 160% profit margin for our investors and ourselves. So a couple of examples of decades of experience that we've had in this particular field of conversions. One is in Miami, where we converted 144 units, valued at $54 million. Post-conversion created about $15 million of equity value there. Property in Honolulu was converted with an increase of about 53%, resulting from that conversion. On the East Coast, we've converted in New Jersey a project that actually resulted in almost a 200% increase in value for the owners there. And Laguna Beach, we did something quite interesting, which was a leased property that we converted to condominiums, creating almost 90% equity returns. Our distinct advantage and edge comes from several specific areas that we've developed and really fine-tuned in the last several years. One is that we do all of our own sourcing and procurement, which reduces our overall construction budgets by 10 to 20%. Now, that might not sound like a lot, but it actually is significant, because what that does is it actually pencils a property that would otherwise not pencil, meaning it wouldn't be worth doing the work if we didn't have those construction costs down to those levels. The other thing that it does is it actually assures consistency and quality, because we're now doing our own procurements instead of relying on a third party or a general contractor. And it also reduces delays, because the materials get there when they're supposed to be there, instead of relying on some sort of third party that may not have managed that process very well. The other thing that really stands out in terms of how we execute is that we are very focused and multi-skilled in terms of our on-site, full-time, active personnel, where we're generally self-performing in areas where other developers would actually hire subcontractors or contractors to do the work. And sometimes that doesn't work out too well. In our case, it assures that we will have less cost in staffing at the project level and at the fund level, and it streamlines our operations and maximizes the efficiency, because those sometimes those situations that don't go right actually end up costing money and time, which will potentially put a project in jeopardy. The other last thing that I think we can highlight as our distinctive edge is that we leverage regional sources and team players into a network that allows us to basically focus on an area with multiple sites and provide that same set of positive aspects that we just described across those particular locations. And it also helps us to identify off-market opportunities in that locale, because off-market opportunities generally provide a better margin than ones that are marketed by brokers all across the landscape. So now that you understand why Still PG is an exceptionally valuable partner for you as an investor to join, with all our experiences and our background and our expertise and those edges that I just described, we should now discuss why the adaptive reuse space. Obviously, there's a lot of different places that you can invest in real estate, but why this space? Why is this so important? Why is this so valuable at this time? Well, here's the investment thesis that I want to share with you. First, there's this office to residential component, which is transforming essentially distressed office space and creating very desirable, well amenitized residential, particularly in areas of urban areas where you see a lot of office space. And it's primarily because we can enter this market with these existing structures at well below value, well below replacement value. So that lower cost allows for new development to be done and still become a very good return on investment as a residential complex as compared to a ground up build out. The other area of interest is hotel to residential. And while this may not be well publicized in the market, whereas office to residential seems to have taken a great deal of interest or created a lot of interest, hotel to residential is actually sometimes easier and better to do. That's where we repurpose, I should say, underutilized hotels, many of them being like vintage 1970, 1980, 1990, into creative, very space efficient rental units. So you generally get smaller units, but high amenities in certain locations that where people like to be outside and want to be outside, creates a high value alternative to these traditional apartments that would otherwise exist as new developments. So we talked about some lower costs that we generate through some of our special techniques, but by buying these distressed properties, as I said, below market value or below replacement value, generates an opportunity to build on that. And we basically reduce the risk because we shorten the time frame in which, as compared to a ground up approach, which might take 30 months from start to finish, these can generally be done about in 18 months. So that 12-month period reduces financing costs, reduces risk, you can get to market faster. So those are all advantages. So the other thing that is important is that if you find, instead of trying to find a piece of land in an urban market, for example, where the demand is high, it's easier sometimes to find a piece of underutilized office building or hotel and actually meet that demand right at the point in which exists. And also, you can use creative ways in which to provide interesting layouts, amenities, and unique features of the property. In some cases, for example, a historical interest to position it for more attraction by the market. So these are all advantages and the concepts for going from office to residential or hotel to residential. So what's compelling beyond that about this? Well, again, we all know we have a huge housing shortage in this country, creating a high demand in high demand markets, particularly. We have inflationary pressures that are affecting our ability to actually develop ground up. This actually meets that, meaning the adaptive reuse option. Also, there's new laws that are coming into effect where the city and state is recognizing that these existing structures can be more readily available for residential housing, and so they're passing laws to allow for that to happen. Very flexible laws where zoning is allowed when it wasn't before for this type of use. And along with all of this, there's a declining demand in most markets for office and in some markets for hotel, which then basically allows for this supply at below replacement value, which then we take advantage of and convert them into residential, which is in high demand. And we all know that after COVID, we all know that the remote work has expanded and risen, which then has affected the office occupancy market. So therefore, again, this has put pressure on values of office structures. And what options do office owners have but to essentially sell it into the market, or they default on their mortgages and their loans, and it actually becomes bank owned, and the banks want to get rid of the property. This is a good opportunity for us to come in and pick these up and repurpose them for what is needed. So the adaptive reuse housing solution, we can break it down into, again, a kind of a summary. Housing shortages exist, almost 3.8 million homes. We need them across the country, especially in urban areas. We have inflationary pressures that have gone up by 35% since 2019. And our adaptive reuse actually reduces our time, as I mentioned, which reduces cost, which is part of the inflationary pressure on home building. And because we are able to minimize, at least in the case of Still Property Group, we're able to control our costs, reduce our cost of overall completion of these units by 12 to 15%. So that's the way we essentially mitigate the inflationary pressures. The new regulations are helping us in identifying opportunities and actually executing on those areas, where the town fathers and the state legislatures are helping with this transformation. And because there's a whole separate commercial depression in terms of office space utilization or older hotel use that's helping us essentially identify these opportunities. So it's a convergence of all of these elements that have made adaptive reuse the place to invest right now. Okay, so if we agree that Steel Property Group is in the best position to take advantage of what's now becoming a very attractive area of investment and development, why this particular place to invest, and why come into our fund as compared to alternative places to invest? Well, first of all, the fund is we are the general partners in the fund, meaning Steel Property Group is Fund One. We are the general partners and the managers. We're raising up to 20 million, although I think the paperwork will show that we could expand it to 50 million, but we're going to hopefully close with the 20 million, the first 20 million that is committed. Right now, our target, and I'll go over this a little bit, but the target that we expect to achieve is a 30% internal rate of return. And that will give us, and that generates into about 130% profit, or what we call a multiple of 2.3. That means for every dollar you put in, you get $2.3 out, as projected. It's a 4-year target deal hold, meaning each of our deals are different time periods, but they average around 4 years. Some will be 3, some will be 5. They average 4. What's most important is that this is an opportunity to earn a very high preferred return of 15% to our investors first, before any profits are distributed from the fund to us as general managers. And after the investors achieve that 15% return, which in itself is very good return, 25% of all additional net cash flow is going to go back to the investors. That's after the cash is returned to you, the original investment, plus a 15% return. Anything over that, the investor group, the fund itself, gets a 25% participation. That is very unusual because in most cases, as sponsors, we earn a promote, we keep that promote, 100% of that promote, and the investors achieve their own returns based on a waterfall. In this case, this fund will receive 25% of every dollar that would otherwise be part of that waterfall that is going to the sponsor. And the management fee is a relatively low 2% of capital deployed, and then it drops down to 50% once your return of capital is achieved. So let me take you through an example of a deal so that you understand how this fund works in the stack of a total dollar of a particular project's value. So if we had a project, and I'll start from the bottom up, it's a little easier. If we had a $56 million project that we expect to need to fund, maybe that includes the acquisition, all of the soft costs, all of the hard costs. It would require essentially a $56 million commitment. Generally speaking, we can finance 65% of that requirement with debt, and that would leave a 35% for equity to be funded. We generally will find limited partners that would participate in that 35%, with contributing 30 of that 35%, leaving a 5% requirement for the general partners to put in directly into the deal. In this case, if with this fund, we expect that Still PG will use, if we had to put in $2.8 million for this particular opportunity, we would have the fund participate at $2.5 million out of the 20 that we're raising, for example, with our first close. $2.5 million would be invested into this particular project, and we as sponsors would put in the balance of the fund of $300,000. So that would be the stack as would going forward. Now, what that means is the $20 million that we're generating will create an opportunity to probably invest in about almost $500 million worth of assets. And then that's going to probably be across 6 to 8 investments, 3 of which we've already have identified and have actually put into the pipeline, and where we have actually have control over those projects and expect to close within the next month or two. And as I mentioned, this would be, dependent on the exact amount that's needed for each project. This example I used is a $56 million example of a total project value requirement. So another way to look at the advantage of this fund is that it basically allows you to participate at a level that normally you cannot participate as an investor, as a passive investor in a real estate deal. What am I saying that? Why am I explaining that way? Well, let's look at it from the left side of this chart. Normally, an unlevered return of a deal might bring in a 16% return, meaning 16% of invested dollars would become your profit on an IRR level. This is a net IRR, meaning year to year internal rate of return. By using leverage, of 10%, let's say, you bump that up to a 25% deal level. And that's the power of leverage. Now, normally that deal level return of 25% is split between a limited partner group and the general partners. So usually the limited partners earn about 18% on that 25%, and then the balance is left for the general partner. And the general partner usually has to perform to actually get the benefit of that waterfall. In this particular case, because of the way we are structuring this transaction, not only will you earn that 18% that a passive investor would earn by actually having a minimum of 15% guaranteed, but you also get the benefit of sharing the 25% that would flow to the sponsor. And that's why, as an investor in this fund, you will be able to essentially double the preferred return, because you're sharing in that promotion that would normally go. That's the what others call the benefit of the sponsor, the carried interest that we normally keep as the sponsor. We're sharing here 25%. That's what's bumping up the full value of this investment to 30%. So what are some of those deals that we have in the pipeline? Normally these type of funds don't have the deals already identified. In this case, we're very fortunate that we have that situation. You have 3 amazing projects that are already under contract, already gone hard. We've already done quite a bit of work. We've already been in these deals for several, in fact, probably a full year on these deals. We haven't closed on 2 of the 3 that we're just looking at. One deal is in Hancock Park in Los Angeles, a really amazing, highly sought after location in the LA neighborhood. It's essentially next to Beverly Hills. That's under contract at $85 a square foot, probably 1/5 of the replacement value of that type of property. It's 160 actually it's about 220 gross square feet. 160 would be available for sale as a final product, which we currently are expecting it to be a residential product. Another is the Pioneer Vista townhome, very active Silicon Valley market, 10 minutes away from Palo Alto. And this is a 10-unit townhome build out, which it's going to be a very quick sale. It's about a 30-month project. So high demand, expected to even do better than projected, but we generally underwrite very conservatively, always like to underpromise and overdeliver. We have a project that I'm going to show you in a minute that was 2 blocks away from here, 1 block away, that we just exited with a 50% IRR for the deal level. We have also an opportunity for the fund to invest in an existing project, but also one not right down the road from us. It's going to be called the Jade at Merritt Island, about a few miles from the SpaceX area. Highly needing of residential rental project. It's going to be similar to what we did in another complex that I'm going to show you as an example. So these are all ready to go, ready to participate, and most of the elements have been de-risked. These are existing projects that are already zoned. So this is an example, 2 blocks away, 1 block away from the San Mateo project property. We did a $45 million condo conversion with 38 units. It took us about 9 months to convert. Initially, our sellout was within 24 months. The return was over 50% at a deal level, multiple approaching 2.0 in a very short time. We remodeled these units. They were 30-year-old property units that were townhomes, sold at around $900 a square foot on the exit. And this is exactly 2 blocks away from the other deal that we just described, one of the 3 deals that were already committed to this fund and using the fund's investment to join. So that's one example. The other is the one that we're doing here in Florida. We're converting a 330 room hotel rooms to 238 Class A apartments. We've already, on phase 1, we're approaching, if not exceeding, 90% occupancy in a short 12-month period. These are highly amenitized properties. We did outdoor theaters here, pickleball courts, fire pits, beautiful spa, 17-foot radius spa, co-working space, gym, and the new phase is going to have other interesting shuffleboard and bocce ball courts and volleyball courts, all to attract the right group. This is attractive to individuals who would otherwise have only opportunities in a new development where the actual rents are about 20% higher. They come in here, the units are slightly smaller, very comfortable, full kitchens, beautiful baths, and yet a lower rental rate than the competition, but much, much more amenities. That's exactly what we plan on doing at the Merritt Island project. It's going to be called, at least the working title now is the Jade Merritt Island, which is going to be about 158 units there. So to round this out and summarize, the opportunity here is to join a fund that has a focus on residential conversion strategy, coast to coast, where there's a need for a high level of demand, but a low supply. We're, still Property Group being using its creative and cost-effective approach to taking these existing properties as quickly as possible at a lower cost and bringing them to market as residential living spaces. Our experience, our team experience of over 30 years with close to $1 billion worth of projects, either completed or in process, puts us in a unique position to take advantage of these undervalued properties and navigating those complexities that otherwise, leave others away, out of the picture. This allows you as the investor to work directly or invest directly side by side with us as the managing members and participating in what otherwise would be our profits. And that way we're increasing your returns from this guaranteed minimum 15% preferred, which means, by the way, that if that 15% is not achieved from one deal, or a group of deals, we as general partners will forsake our profits to make sure you earn that minimum 15% before anything else is distributed to us. And that significantly will increase your return to what we project to be 30% internal rate of return, or a 2.3x, or what is essentially 130% profit over the average holding period of 4 years. And with that, I want to thank you for listening and paying attention to my presentation. I'm prepared to answer any question that you have. Uh, Perhaps the moderator can give, I think you're collecting the questions,
Correct.
Alan?
Yeah.
Okay, sure.
So yeah, anyone in the audience, if you have a question, please drop them in the Q&A chat box. I'm already seeing some questions coming in. So let's see. The first question I see, how is the current economic climate, especially rising interest rates and inflation, impacting urban real estate development?
It's a good question. It's quite a turmoil right now, of course, between the tariff wars and the some of the other economic uncertainties that are prevailing. I would say, generally speaking, the things that are affecting us today is inflation. The rising rates of interest rates has been significant over the last, roughly 3 years. It seems like it's going to be sticky on the way down, right? So today, for example, I think the Fed decided they're going to leave rates where they are. And so I think while that's happening, inflation is affecting our pricing to deliver products at a reasonable cost into the market. Interest rates are part of that inflationary cost. Here's what's interesting. Urban demand and even just basic real estate housing demand is not letting up. So it's a frustrating market for developers. And one of the reasons why adaptive reuse has become much more interesting and sought after by developers is because of this challenge of rising costs and yet rising demand, but not being able to meet it. But here's the interesting problem. Most developers that are experienced from the ground up, infill built, structures have virtually no specific history or experience in doing adaptive reuse. Adaptive reuse requires a certain sense of focus on the particular difficulties of adaptive reuse. If your mindset is to go in knowing that you're going to have to adapt and address issues that you have planned for, but in a way that is unusual from the normal market conditions, you're you're going to be much more successful. That's why we're successful when others may not be, because we approach this knowing the difficulties, understanding it, planning for it, and executing on those challenges.
Thank you. Another question is, what are some of the biggest misconceptions about converting office space into residential units?
Oh, okay. Uh, I'll speak from the perspective of the developer first. I just kind of it's a offshoot to what I just described. Many times developers enter the adaptive reuse thinking, oh, how hard could it be? I'm very experienced with this. We've built, thousands of units, millions of square feet of commercial space. We should be able to execute. That's a misconception from their perspective, because again, you need to have the right team, the right focus, the right approach right from the start. And many times they walk in and they're surprised and they just can't overcome the difficulties. We've seen that in the past. We hope that that improves over time. People will learn what they need to do. But the good thing is, for our investors, you have us. We have the experience. We've done this for 30 plus years. Uh, while we built some new projects, 90% of our projects have been adaptively reused or conversions that of existing structures. That's probably the inverse of what most developers deal with, where 90% of their history is new ground up projects, and maybe 10% were existing structures that they renovated or rehabbed. So it's a very different perspective. The other misconception is probably from the resident side, where they sometimes will expect maybe more of a newer projects where amenities are very standardized. They don't necessarily have many of them because it costs too much for the developer to build those out. Whereas ours have unique amenities because we adaptively reuse courtyards that were not necessarily used. For example, we put a pickleball court at the Jade at Winter Haven when there was no such thing. We didn't put in a tennis court, which nobody uses anymore. We're putting in elements that would not normally be in that developer's schedule of things that they want to do. The other thing is the misconception is, you can live in a 500 square foot, well structured and well designed one bedroom and be very comfortable in Florida or California, where most of your living is outside, and enjoy higher level of amenities while having a lower rent on a monthly basis, with more money to spend on other things like cars and going out. So this is a new concept for many to downsize in terms of the interior living space, but to uh, upsize in amenities and also saving rent dollars that will improve other situations. So these are just two or three misconceptions that I think will come to mind.
Yeah. And the last question I see here is, can you share a little bit more info about the Reg D investment opportunity that is currently available for the accredited investors?
You mean with still PG Group Fund One
Correct.
specifically?
Correct.
Yeah. Um, yeah, so the advantage to this project, to this fund, I should say, over others. I mean, look, there are other groups that are trying to raise money as passive limited partnerships. Generally, they don't have the low minimum entry. In our case, the average self-directed, accredited investor can participate with us. And the entry point is low enough for you to participate, which is one unique aspect. But more unique here is that this is a GP fund where you're investing side by side with us. Normally, we put up our full 10% and we do several projects, and we return the returns for us if we meet and exceed our objectives is very attractive, but it is also very good for our limited partners. But they are promoted and they're not participating in that promote period piece that comes off the top once a certain return is established. Generally, that accredited the minimum preferred return is usually around 8 to 10% in most funds. In this case, it's 15%, meaning the investors are going to receive 15% of the first dollars available, besides the return of their capital, of course. They're going to get the first 15% of that accredited investment, whether it's accrued or paid out on a monthly or quarterly or annual basis. The other thing is that what's exceptionally unique is that once a particular project achieves a full distribution, and where everyone's returns are given back, they achieve their preferred returns, whether the limiteds are getting 8%, our investors are getting 15%. There's excess proceeds based on our projections, and now instead of participating at a zero of that promote, the investors in this particular fund are going to share in 25% of those promotion profits, which significantly brings the internal rate of return or the return overall to the investors in the fund up to a 30% internal rate of return. It may be exceeding that depending on our true results. It could also be below that. But the key thing here is that you have the downside protection of a higher preferred than normally experienced and enjoyed by limited partners, meaning the 15% preferred return. And then you have this ability or the opportunity to benefit from that promote piece, the 25% promote piece, that brings us to almost a 30% or over 30% internal rate of return projected.
Well, Jack, I'm not seeing any other questions coming in. Is there anything you want to leave the audience with? How can they contact you? And yeah, just any final tidbits before we sign off here.
Well, one of the things that I may not have addressed in your first question that I'm thinking about now is how is the tariff playing into the tariff wars playing into our
Mhm.
costs? It's a question I get a lot from not only investors but also lenders, right, who are somewhat concerned about this forward-facing issue for the whole nation and for the globe, actually. So one of the things I want to relay to the audience is that prices are up. They're up by somewhere between 5 to 10%, depending on the category. Now, that part of that is probably a pent-up need for producers, manufacturers to expand margins that were compressed during the COVID days. And this is an opportunity for them to kind of try to do that. And there's a bit of success on that level. We're managing that as best we can because we're doing our own procurements. I think we're in a very unique position to benefit from that. But what we've realized and what others need to realize is that you can't stop there. The procurement process, whether you do it yourself like we do, or you let others do it, you have to expand that because you need more procurement options in order to make sure that you're taking advantage of those who are more flexible in the market, willing to reduce their costs for bigger market shares, but you're not going to find those people if you rely on your tried and true vendors. So you got to expand your vendor base. The other thing is to remember that if China's situation doesn't improve, that 125 to 145% tariff that is now imposed, if that is um, is not normalized back to something much more approachable and manageable and sustainable, it will affect global pricing and supply chains substantially. And it's not just the stuff coming out of China, because if China's net costs are higher, you might see others in other countries that don't have the same tariff imposed may actually try to raise their margins because now they know China isn't going to be a real option for many here in the United States. But what's unique is in the case of Still Property Group, we anticipated some of this even earlier than when the beginning of the year went after, because we knew what the new president was planning to do, so we anticipated that China would be a significant you know problem for us to buy through. And we do buy some things from China, but mostly in other South Asian markets. So we pivoted to those other options earlier this year and got our materials in before the imposition of that tariff back on April 2nd. And so that's the kind of mobility and flexibility that distinguishes us from others. And we actually demonstrated that in this particular recent event. So I just wanted to bring that to your attention or to the group's attention here. And for those who are developing themselves that are listening, I hope you take some of those comments and advice that I'm giving to heart. So, the thing that I think I want to end with is that, the adaptive reuse space, while it is on everybody's tongue now because of all the reasons I described, right? Because we have a greater stock of these available existing structures. You can get into them with lower costs and a faster delivery. All of that is good information and really should be the pinpoint of your decision to make an investment in the adaptive reuse space. Hopefully, it's within our group and with our fund for all the reasons we identified. But most important, it's to join up with a developer and a development team that has the experience to navigate those difficulties that come with that adaptive reuse space. There's no question. There are difficulties. Floor plans are not ideal. Plumbing and HVAC sometimes is difficult to come into, to be able to manage, right? Outdoor space sometimes is limited. So you need to be very creative and be able to use what you have intelligently. There are some good things. The utilities are in place, the structure is there, local laws are being helpful in the process, but at the end, you need the expertise to navigate the process and maximize and optimize the opportunity. And the investors in this fund will have that through Still PG, because we have that experience. We've demonstrated it time and time again. And we already have the 3 projects that are already in place that could absorb almost half of the 20 million we want to close with on the first round. And that is unusual too, because in most cases, as I mentioned, you invest in a fund, the fund defines what it's going to do and where to go, but they usually don't have the projects directly under contract and already de-risked, as we do with those 3 that I mentioned in my presentation. And that's a very unique perspective as well. So I welcome you to join the Still PG Group Fund 1 and benefit from all the aspects of it, the 15% pref and the participation in the promote, which will hopefully maximize your overall return. And if you have any questions and you need to or would like to participate, I think you can go to stillpg.com, where you can be directed to the additional information, our official offering memorandum, and the investment documents that you can review and then execute if you want to participate.
I was on mute there. Thank you, Jack, for that. And I added the link to the stillpg.com website. Yeah, and yeah, thank you, audience, for attending the webinar. If anyone has any questions, please reach out to Jack directly. This whole webinar has been recorded, so we will be sending out a replay of the webinar. And I hope everyone has a good rest of their day. Thank you, everyone.
Thank you.